Hello, everyone, and thank you so much for joining me today. I'm thrilled to be here with you to share a story that is as fascinating as it is terrifying. If you look at the screen behind me, you will see a jagged crimson line crashing violently downward, shattering the grid, superimposed over the faces of panicked, bewildered crowds. Today, we are going to dive deep into a story of destruction. We are going to decode the anatomy of financial ruin. Over the past century, the American financial system has experienced countless periods of turbulence, but there are five specific crashes that profoundly alter the trajectory of history. These are the Great Panic of 1907, the Great Crash of 1929, Black Monday in 1987, the subprime meltdown of 2008, and the flash crash of 2010. If you look at these five events superficially, they seem entirely disconnected. The catalysts were different, the technology was different, and the names of the companies involved were different. You might think that a crash in the era of steamships has nothing in common with a crash in the era of fiber optic cables. But when we strip away the surface noise and really examine the rhythm of a market moving from euphoric boom to devastating bust, a terrifying realization emerges. The underlying mechanics are practically identical. For over 100 years, the only things that have truly changed are the stock prices, the financial technologies, and the investor demographics. What remains completely unchanged is human nature, specifically the endless cycle of greed and fear. As author Scott Nations points out in his book, people always have far too much greed, yet rarely have enough fear. We get so caught up in the good times that we forget the inherent risks. Today, we will embark on a journey across a century of financial history to dissect the engine that drives these crashes and hopefully learn how to protect ourselves in the future. Let us move to our next topic, which I like to call the paradox of the American wealth machine. If you look at the blue curve on the screen, you will see the staggering acceleration of transaction velocity over the last century. Think about the year 1907. If you needed to settle an insurance claim back then, it literally took weeks. Why? Because to pay for the massive damages of the 1906 San Francisco earthquake, actual physical gold had to be loaded onto steamships in London and sailed across the Atlantic Ocean. We lived in an era measured in weeks. By 1929, transaction speed had shrunk to minutes. The famous speculator Michael Meehan literally set up a mobile brokerage office on the ocean liner Berengaria. Wealthy passengers could sip champagne in the middle of the Atlantic, send a radio order to New York, and have their stock trades confirmed in under 10 minutes. Fast forward to 1987, and the computer age brought us down to seconds. The New York Stock Exchange introduced electronic systems that allowed massive institutional orders to be routed directly to the trading floor in the blink of an eye. By 2008, highly complex securitization models processed the risk in fractions of a second. And by the 2010 flash crash, traders in Chicago and New York were executing trades in milliseconds. Financial firms literally spent millions building microwave towers just to transmit data 5 milliseconds faster than fiber optic cables. But here is the paradox. The physical speed of a transaction shrank from weeks to milliseconds, and we built the most technologically advanced wealth machine in human history. Yet, the underlying architecture of a market crash remained completely identical across this century of evolution. The philosopher Karl Marx once wrote that history repeats itself, first as tragedy, second as farce. Well, on Wall Street, history repeated itself 5 times. Technology did not make us smarter, it merely accelerated the speed at which we destroy wealth. This brings us to the core of our discussion today. If the mechanics of these crashes are identical, what exactly is the mechanism? We have decoded it into what we call the universal crash engine. A systemic crash is never just one bad thing happening. It is not a singular failure. It is a volatile sequential collision of 5 specific gears. Let me walk you through them. First, we have the innovation. Before every crash, a new, poorly understood financial mechanism emerges, promising to reduce risk or create hyper-efficiency. It sounds great on paper, and everyone rushes to use it. Second is the leverage trap. Under the disguise of this shiny new innovation, massive debt and complexity are layered invisibly into the system. This is like building a skyscraper on a foundation of toothpicks. Third is the external catalyst. This is a spark. An unforeseen geopolitical, regulatory, or physical shock hits the market. It is a match dropped into the powder keg. Fourth is a liquidity illusion. This is a terrifying moment when panic sellers realize that the buyers they assumed would always be there have suddenly vanished. You think you can easily sell your assets, but when you try to head for the exit, you find the doors are locked. Fifth, and finally, we have the rupture and outcome. The market collapses entirely, and it almost always requires extreme, unprecedented human intervention to stop the bleeding. Now, let us test the engine by running four historical crashes through it, starting with the year 1907. Let us rewind the clock to the Gilded Age. In 1907, our first gear, innovation, took the form of trust companies. These acted as shadow banks. Traditional banks were strictly regulated and required to hold 25% of their deposits in cash reserves. But trust companies exploited legal loopholes, holding almost zero reserves while offering depositors high interest rates up to 5%. They essentially combined the worst elements of a savings bank and a risky hedge fund. Enter our second gear, leverage. A cunning copper magnate named F. Augustus Heinze attempted to use heavily leveraged funds to corner the stock of a company called United Copper. Heinze was a man who built his fortune exploiting loopholes, but his attempt to corner the stock market failed spectacularly. United Copper's stock collapsed from $60 to $10 in just days, wiping him out. But Heinz's failure was just a kindling. The real external catalyst had nothing to do with Wall Street. In 1906, a massive earthquake devastated San Francisco, burning half the city to the ground. British insurance companies were on the hook for the payouts, and to cover the astronomical claims, the Bank of England had to ship 14% of its total gold reserves across the ocean. To stop this gold drain, the Bank of England aggressively hiked interest rates to 6%, which violently drained liquidity from the global financial system. With no global liquidity, the rupture hit New York. Rumors spread that the Knickerbocker Trust Company was tied to Heinz's failed schemes. Panicked depositors lined up in the streets, and in just 3 hours, they withdrew $8 million in cash, forcing the massive Knickerbocker Trust to permanently lock its doors. A massive liquidity trap was sprung. The government was powerless. It required the man on the right side of your screen, J.P. Morgan, to step in. Facing the total shutdown of the New York Stock Exchange, the 70-year-old Morgan locked 50 of New York's top bank presidents in his personal library. He refused to unlock the doors until they collectively pledged $25 million to save the system. He single-handedly stopped the panic through pure human willpower, acting as a one-man central bank. We survived 1907 and entered the Roaring Twenties. Welcome to the Great Crash of 1929. This time, the innovation was called the investment trust. These were the ancestors of today's mutual funds. Promoters hired esteemed economics professors from universities like Princeton and Yale to promise the public that scientific diversification could eliminate risk. It gave everyday people a false sense of security. But beneath this academic facade hid a terrifying leverage trap. These trusts began borrowing money to buy stocks. Then, they started buying shares of other leverage trusts, creating a financial Russian nesting doll. Some trusts operated at an 8-to-1 leverage ratio. Think about what that means. If you put in $1, you are carrying $8 of debt. This meant that if the underlying stock market dropped by just 11%, the entire pyramid would instantly evaporate. Look at the ocean liner on your screen. It perfectly captures the euphoric hubris of the era. Remember Michael Meehan? He ran a shadow pool to legally manipulate the stock of RCA, driving it to astronomical highs. In 1929, he opened his brokerage on the Berengaria ocean liner. Wealthy investors were quite literally gambling on the stock market while floating in the middle of the Atlantic Ocean. Then, the catalyst struck. The Federal Reserve, trying to cool the speculation, applied direct pressure policies to restrict credit. Simultaneously, Massachusetts regulators shocked the system by denying a stock split for Boston Edison, publicly stating the stock was inflated to an unreal level by speculators. The myth shattered. The rupture hit in late October. The massive debt triggered forced margin liquidations. Everyone had to sell to cover their loans, regardless of price. The avalanche of sell orders was so massive that the stock ticker tape fell hours behind, leaving people completely blind to how much money they were losing. The 1929 crash didn't just break the stock market, it plunged the entire world into the Great Depression. Let us fast forward to 1987. Computers have taken over Wall Street, and our crash engine gets a digital upgrade. The innovation in 1987 was called portfolio insurance. Two academics from Berkeley used complex mathematics to invent a strategy that supposedly guaranteed a stock portfolio could not fall below a certain floor. They promised institutional investors that they could participate in the upside of the market while being perfectly protected from the downside. It sounded like magic. This created extreme leverage and automated feedback loops. Portfolio insurance relied on computers automatically selling stock index futures the moment the market started dropping. They linked this to the New York Stock Exchange's new electronic DOT system, which allowed arbitrageurs to instantly execute massive baskets of stocks. The catalyst arrived in mid-October. The United States announced a terrifying trade deficit, sending interest rates soaring and the dollar plunging. At the exact same time, a congressional committee proposed a takeover tax designed to kill the corporate mergers that had been driving the bull market. The liquidity illusion and the rupture collided on the 19th of October 1987, which we now know as Black Monday. When the market dipped, the computers blindly executed their portfolio insurance algorithms, dumping billions of dollars of futures. The inventors had assumed there would always be rational buyers waiting to absorb these sales. They were fatally wrong. Liquidity vanished. The automated feedback loop fed on itself. The computers sold futures. The arbitrageurs sold stocks to match the futures, which drove prices lower, which triggered the computers to sell even more futures. It was a doom loop. The system severely overloaded, and the Dow Jones plunged a staggering 22.6% in a single day, destroying over $1 trillion in wealth. It remains the worst single-day percentage drop in United States history. This brings us to a crash many of us remember all too vividly, the crisis of 2008. By the early 2000s, Wall Street's innovation was a toxic alphabet soup: mortgage-backed securities, collateralized debt obligations, and credit default swaps. These tools completely uncoupled the risk of a loan from the responsibility of issuing it. This created the ultimate leverage trap. Subprime originators began giving zero-down mortgages to people with no income and no jobs. Why? Because they didn't keep the loans. They immediately sold them to investment banks. But how did Wall Street convince the world that these garbage loans were safe? They used the math formula you see on your screen. That is the Gaussian Copula, championed by a statistician named David Lee. This deeply flawed formula convinced the rating agencies that if you bundled enough toxic subprime mortgages together, the mathematical correlation magically transformed them into AAA rated gold. Blinded by this financial alchemy, the insurance giant AIG wrote $80 billion in credit default swaps, essentially insuring this toxic debt, believing the risk was practically zero. It is like taking a bunch of rotten apples, putting them in a blender, and convincing a health inspector to give the smoothie a 5-star rating. The catalyst was inevitable. The housing bubble burst. Subprime borrowers defaulted en masse on their zero-down mortgages. Lehman Brothers, choking on toxic real estate, went bankrupt. Lehman's collapse triggered the rupture. Because AIG had insured these collapsing assets, they were hit with an unimaginable $80 billion margin call. They did not have the cash. The entire global banking system froze instantly. Without a massive, unprecedented bailout from the American taxpayer, the global economy would have simply stopped functioning. Just 2 years later, the machines showed us their true terrifying potential. Welcome to the 2010 flash crash. By 2010, the innovation was entirely digital, high-frequency trading and automated execution algorithms. The human floor trader was dead, replaced by the server rack and the fiber optic cable. The leverage here was the blind stupidity of the code. A mutual fund named Waddell and Reed needed to hedge their portfolio, so they deployed an algorithm designed by Barclays to systematically dump 75,000 E-mini futures contracts. But the algorithm had a fatal flaw. It looked at the trading volume instead of price. It mistook the high-frequency hot potato spam of cancelled and replaced orders as genuine market liquidity. It thought the market was deep, so it just kept selling relentlessly. But what was the catalyst? Look at the burning building on your screen. In May 2010, Greece was defaulting on its sovereign debt. Violent riots erupted in Athens. A mob threw firebombs into the Marfin Bank, and a young, pregnant financial analyst named Angeliki tragically burned to death along with two colleagues. This horrifying real-world violence in Europe triggered massive global fear regarding a European debt contagion. That fear triggered Waddell and Reed's emotionless algorithm in Kansas City. On the afternoon of May 6th, the rupture happened at the speed of light. As the algorithm blindly dumped futures, high-frequency computers went insane. They triggered 25,000 repricings per second. The sheer volume of electronic messages completely overwhelmed the data pipes of the stock exchanges. Actual buyer liquidity dropped to 14% in a matter of minutes. In this vacuum, blue-chip stocks like Procter and Gamble crashed, and Accenture actually traded for one single penny per share. The Dow Jones plunged nearly 1,000 points in minutes. The code had literally weaponized the stock market. When we step back and look at these 5 crashes, a truly terrifying picture emerges. Let us look at this chart. Over the past century, the execution velocity of transactions has shrunk from weeks to milliseconds. That is the blue exponential curve you see here. It represents human ingenuity, computer systems, microwave towers, and complex securitization. We are moving faster and building more complicated things than ever before. But I want you to look at the gold line cutting straight across the graph. That line is human nature. It represents our greed and fear index. Across a century of radical technological change, the biological and psychological vulnerabilities of the market remain absolutely flat and completely unchanged. The disasters of 1987 and 2010 teach us a chilling lesson. Algorithms may have replaced the shouting floor traders, but the human programmers simply embedded the exact same human hubris and panic directly into the computer code. Technology did not eradicate our flaws, it merely weaponized them at the speed of light. We build systems that are supposed to be objective and rational, but we infect them with our own subjective desires and blind spots. And so we arrive at our final conclusion, the immutable human factor. After decoding the anatomy of a century of financial ruin, we learn that a market crash is never merely a failure of mathematics, and it is never just a glitch in the machines. It is the inevitable, violent collision of human hubris with an unforgiving reality. During the boom times, we stop worrying about stock prices falling. We blindly trust complex derivatives and opaque algorithms that we do not actually understand, assuming they will never turn against us. We think we have outsmarted risk, but the universal crash engine is always waiting in the background. When excessive expansion collides with the sudden evaporation of liquidity, the architecture of the crash is always identical. History issues us a definitive warning. The rules of the machine may change, but the operator does not. To understand why the stock market crashes is to understand ourselves. It is to understand our endless capacity for greed, our paralyzing vulnerability to fear, and our blind faith in the illusions of technology. My hope is that by taking this journey through the anatomy of ruin today, we can all maintain a deep sense of humility, vigilance, and respect for the markets long before the engine of the next crash begins to turn. Thank you so much for joining me on this deep dive today. It has been a pleasure sharing these insights with you. Stay curious and stay grounded. Goodbye for now.